Hello and welcome to the look ahead for Wednesday, the 26th of February, with me, Fiona Cincotta, Senior Market Analyst at City Index. So overnight, we'll be watching for Australian monthly inflation figures. In the European session, there's German GfK consumer confidence to be watching out for. We've also got US new home sales and EIA oil inventories later in the day. Then after the US close, we'll be watching very closely the earnings from Nvidia. Now, when we be watching these keenly awaited earnings, we're watching really for signs that the most important customers of Nvidia, big tech, may be starting to tighten their belt after years of huge spending or on capital spending. I mean, this is going to be particularly concerning if we're thinking about this in relation to the fact that there could also be signs of a breakthrough in AI in China, where we've seen this sort of huge spending may not be necessary on AI anymore, with the announcement from DeepSeek. So I think there's going to be a lot of focus on whether we're seeing that slowdown in growth, a particular slowdown in growth. Obviously, we're expecting revenue to rise 72% to 38 billion. Earnings per share is expected to rise 62% to 85 cents per share. This is going to be considerable deceleration in growth. So it's going to be interesting to see how the market responds to that, and particularly if we get some disappointing guidance. So as I said, key things to be watching out for will be signs that the major customers, clients are tightening their belts, reining in capital expenditure, and that is going to be particularly worrying at a time when AI from China is sort of suggesting that maybe that huge spending may not be necessary. Now, obviously, we will also be hearing from CEO Jensen Huang, who will have a chance to support his idea of why more spending on AI is needed. Now, this is the chart that we're watching here. This is Nvidia. Interestingly, it failed to break out above that 142 level, which is the gap that we've just been watching there. Rebounded lower, but it is still staying above the 200 SMA for now. We did have a little bit of an attempt to break below it, but it's back above it for the time being. I mean, we've seen that it's sort of the share price has not moved much since reaching that all-time high of 153 at the start of this year. We've seen a couple of lower highs taking place. But in order for sellers to really extend that bearish trend, we would need to break below that 200 SMA at 126 and move back down towards here to the 115 level. If we get a break below that, that's going to create a lower low and could see an extension of the bearish mood trend down towards the 100 level mark. We find that the 100 SMA holds because the market's impressed by the outlook and the numbers that we're seeing. Then on the upside, the number to be watching out for is the 142. That was the high from February. If we can get above there, then that will bring the all-time high of 152 back into focus. Now, obviously, it's also worth keeping in mind that given that this is such a huge stock and so important to the AI trade, we'll be watching also very closely what will happen as far as the Nasdaq is concerned. Nasdaq's had a really rough run of late. We run into those all-time highs there at 22,225, and the price has actually then been falling quite dramatically lower. We've had a couple of had that weaker data out from the US. We've obviously got lingering concerns over trade, tariffs and global trade wars. We've also had Trump suggesting that he's going to be increasing tariffs, increasing restriction exports on chips such as those from Nvidia and Intel to China. So this has all had quite a big impact on the Nasdaq. We've also had consumer confidence in today from the US, which is weaker than expected. Just testing the 100 SMA as we speak. It's just above that 21,000 level, at about 21,100 now. That's going to be the level to be watching on the downside. Obviously, momentum is on the side here. We've got the RSI below 50. We've had pretty steep sell-off, but we have got a little bit of a longer, lower wick, which may suggest that there's little selling demand at those lower levels. But if we get a break below, a meaningful and the close below the 100 SMA and this 21,000 level, that opens the door to here, 20,750, which is where we've seen a lot of these longer, lower wicks test. So that will be interesting to see if we can get if sellers can get down to that level and retest it. Below there, obviously, you've got the 200 SMA at 20,200. But if we find this level does hold, if we get upbeat numbers from Nvidia, obviously that's going to have a wider implication across the chip sector and also the broader market. Then we might actually see a recovery. This will be the level to watch on the upside, 21,500. That's the 50 SMA. And above there, we've got sort of this level here, which is 21,850, which is the high that we saw at the end of January, ahead of those all-time highs. Now, also mention that we do have some data from Germany. So let's just take a quick look at what's going on with the DAX. Obviously, been a very busy week for Germany. We had the elections over the weekend where the Conservatives won. We've got Friedrich Merz, who's creating talks at the moment to be able to form a coalition. We had GDP data out today from Germany, which showed a 0.2% contraction quarter on quarter in Q4. Now, data tomorrow we'll be looking out for is consumer confidence, expected to improve slightly to negative 21, up from negative 22.4. We do get an increasing, improving outlook as far as consumer confidence is concerned. That could help drive some demand for German stocks, and we could see the DAX push a little bit higher. Obviously, if we get increased consumer confidence, then that tends to lead to increased consumer spending, which would be beneficial for the economy and for some stocks. So this is why we'd be expecting to see upbeat data helping the DAX rise towards the 23,000 level. If we get a disappointing data, then be watching out on the downside, 22,100. That's the low that we saw at the beginning of the week. If we could take that out, that's going to form a lower low, and it opens the door to 21,500. Sort of creating a fundamental change into this chart before bringing 21,100 into focus. Just finally, we're going to take a quick look at oil, which has fallen really quite sharply today. Obviously, we did have sort of the talk about the Iran sanctions, which hasn't favored the oil market at all. In fact, there are concerns about the demand outlook as we get that weak data in from the US. Now, that's opened the door here to this level here, which is the 60, the 69 dollars. We've broken below 70. We've come out of this little range that we've been trading in. Now we've got the EAI. Well, we've still got API inventories to come later this evening and the EIA inventories tomorrow. But it appears that sort of concerns over the health of the US economy is actually just driving this loss, despite the fact that we're seeing increased sanctions on Iran, which should potentially mean tighter supply. But if we do get a break below the 69 level, opens the door to here to around the 67, where we've got this support zone on the downside, which it didn't manage to break below when it was testing that across the September to December, the last quarter of last year. But that is a fairly strong engulfing, bearish engulfing candle. So we would expect potentially to see a test of this level here. On the upside, any recovery needs to make it above the $70 a barrel before we can start sort of looking towards $73 a barrel. A rise above there can create a higher high and exposes the 200 SMA there at 74 before bringing 75 into focus. Obviously, if we get lower than expected inventories, then if we get a larger than expected draw in inventories, that is going to be sending the oil prices lower than if we get the other way round. So that's everything that I'll be watching tomorrow. Obviously, any more comments from Trump will also be driving the markets. But I hope you've enjoyed what you've seen today. And if you do, then please do give this video a like.